Thank you for accessing our first quarter 2024 financial market update. I'm Jeff Schmidt, Director of Investments at Vision Capital. The last several months have witnessed slower progress in reducing the rate of inflation to a sustainable level. In fact, most measures now show inflation worsening. A soft landing will be achieved if this is just a bump in the road. If it is more structural, then a complicated economic and financial market outlook becomes likely. U.S. stocks performed very well in the first quarter as the S&P 500 increased nearly 11% and closed at a record high. Most international stock markets also performed well, with many reaching new highs. Notably, Japan's Nikkei index reached a new high for the first time since 1989. Other markets with new highs were Europe, Canada, Australia, and India. Bond returns were modestly down as intermediate and long-term interest rates increased. Interest rates are responding to robust economic data, a strong labor market with wage gains, and a halt in disinflation. With over 13 months of base interest rates above 4.5%, all lag effects of monetary policy have been fully absorbed. Is the economy operating above its potential, or is sticky inflation merely a brief pause in the transition back to 2%? Interest rate markets currently account for cuts in the Fed funds rate shown in the chart on slide 5. The terminal rate is the Fed funds rate at the end of the easing cycle. Referred to as the neutral rate, its implication is the rate in which policy is neither accommodative nor restrictive. A slower pathway of cuts, or a higher terminal rate, would result in interest rates rising. A faster pathway of cuts, or a lower terminal rate, would result in interest rates falling. The longer the economy operates above normal, and the longer the road of disinflation, the greater the risk of a policy mistake. Recession becomes likely if nominal GDP growth suddenly falls below the Fed funds rate. Any credit imbalances, such as commercial real estate, would be exposed. We still believe a soft landing is most likely. Coupled with a productivity boost from AI, economic benefits would be widespread. And still, small capitalization stocks are priced cheaper than large cap stocks. The chart on slide 6 shows the largest price-to-earnings valuation discount versus large caps in at least 20 years. We anticipate that consumer spending will weaken through the year as excess savings from the pandemic run out. This will cool aggregate demand and aid disinflation. We have increased investment in small cap stocks as the soft landing will benefit a wide range of companies. Our investment process is active, and we expect to be active in the coming months. Thank you for watching, and we look forward to speaking with you soon.